Price is what you pay. Value is what you get. I'm not sure if you have heard this before. So let me repeat that once again. Price is what you pay and value is what you get. See, valuation is a very complex term, but it is very, very important. Why? See, it's not about buying something which is cheap. It's about buying something which is valuable. What is valuable to one person may not be very valuable to the another person. For example, some of you are ready to pay 70,000 for an iPhone, for a basic model of iPhone. Correct? Is it cheap? Is 70,000 cheap? No. But you think 70,000, it is worth. You can pay so much for it. But at the same time, if I ask you to pay maybe let's say 30,000-40,000 for a Redmi phone, you will be like, oh no, that's too expensive. So here it's not about which is more, which is less. We all know 30,000 is less than 70,000. But when it comes to valuation, we feel, oh, we can maybe give 70,000 for an iPhone. If there are some haters of iPhone, this is just an example. Let's agree Android is better than iPhone, or if you think the other way around, that's okay, totally fine. But then here I'm talking about valuation. So same thing even with our investments or the securities that we invest in or anything, the real estate that we invest in. Value is important. You will be ready to pay a higher value for a particular piece of land than you would pay for another piece of land in a remote area. Correct? If it is in city limits, you are ready to pay that extra premium. Why? Because you feel it is valuable. So everywhere we need to know what is its right value. If I talk securities in particular, I keep getting questions. Sir, which share to buy? Should we buy something which is having a share price of 10 rupees, 12 rupees? Because you get that feeling that it is cheap. Correct? If I talk about Vodafone Idea, 10 rupees, it sounds cheap. But if you keep buying that is cheap, you will only be investing in something which may not be very good. Correct? Chinese products sometimes are very cheap, but you don't trust them. We say Chinese product. Cheap, but not very durable, not good. It may break and so on. So it's not about buying what is cheap. It is buying the valuable good for less price. For this, valuation becomes very, very important. So that's what we're going to see in this particular chapter. This chapter I'm going to teach you how to do the valuations. Remember, valuation from one person will be different to another person. But here, from academic point of view, the data that is given to us is same. So we will all get same value only. But in practical world, it is a very, very complex topic. This chapter name is Security Valuation. Let's see the overview of this chapter. Investment involves committing funds with the objective of earning returns. See, when we make an investment, we want our investments to earn money for us. See, we earn money, we invest them, and then we expect our money to make more money. Even when you are sleeping, your money should earn for you. Correct. Next, we have return should compensate for time value of money. First, we have time value of money. What is time value of money? We know that the value of money keeps coming down. What does that mean? Like if at all I have 100 rupees, I can buy something with that 100 rupees. But if I have to buy the same thing, let's say after 2 years, that 100 rupees won't be enough. Your purchasing power will come down. Then we have inflation. What is inflation? Inflation is increase in the prices of day-to-day commodities. And then we have risk. So when we make investments, we are taking risk. What risk? We will have some default risk. That is, we may not even get back our capital. That risk is always there. And whenever there is risk, it should be compensated by returns. So we want a return from our investment. Investors estimate an asset's intrinsic value. We need this value. This is all that we are doing in this chapter. We are finding what is the actual value based on the parameters that we have got. And why do we need intrinsic value? To see whether the market price is fair. Because in market, anybody can ask for any price. If you have a piece of land, you can say, I need 1 crore for this. Correct? People ask. But how do you know whether that 1 crore is fair or not? We need to find out its real value, the true value. And that's why we need to calculate its intrinsic value. And then we can compare. So if at all we get intrinsic value to be 80 lakhs, he is asking for 1 crore, then we know it is overvalued. And our general rule is, what is overvalued, we do not buy. But let's say, according to your valuation, you feel that piece of land is very valuable, it is worth 1.2 crore, he is selling it for 1 crore, definitely we buy what is underpriced. So this intrinsic value has to be calculated. Everybody's estimates will be different. If everybody's estimates were same, then there would be no buyer and seller at all. There would be no trading happening at all. Everybody would buy or everybody would sell. So one person thinks it is overvalued, one person thinks it is undervalued. That's why one person buys, one person sells. That's why we have trade. Knowing an asset's value is essential for making sound decisions. I told you to take decisions whether to buy or sell. It will also help us in portfolio selection, what to buy, what not to buy, takeovers, pricing takeovers, and business financial decisions. Any financial decision for that matter, we will be doing our cost benefit analysis. We feel it is underpriced, we buy. Remember the golden rule, we buy what is underpriced, we sell what is overpriced. Don't say that we buy what is cheap. We don't sell what is expensive. The expensive one, if it is available for less, we don't say it is cheap. We say it is cheaper little bit than the expensive one. That means it is undervalued. So have the clear difference between cheap and undervalued, expensive and overvalued. The fundamental principle of valuation are the same for all the assets. Ultimately it is same. Ultimately we are seeing whether it is underpriced or overpriced. We'll move on to the next one now. We'll move to the concepts. The first concept that we have is required rate of return. Very important. Very important when we value the security or we value the asset. We need to know what is the return that we want from that particular asset. Required rate of return is the minimum return an investor expects from the investment over a specified period. Now, if at all you go and invest money in FD, you get, let's say, 6%, 7% return. Now, if you have to invest in equity share, will you be happy with 6%? Will you be happy with 7%? Will you even be happy with 9%? Maybe, maybe not. 9% is not enough sometimes because you think that 7% when getting aram se, just by keeping that money in the bank, which is considered to be safe enough. If I'm taking extra risk in investing in equity shares, I need more return from it. I would need maybe 13%, for 15% at least. It compensates the investor for time, risk and opportunity cost. We need it for time. You are investing it for a period. You're taking risk. Okay, and opportunity cost. What is opportunity cost? If at all you're not investing in this, you could have invested it for something else. The cost of your next best alternative. Correct? So if you're now listening to this lecture, you are having some opportunity cost. Maybe that opportunity cost is your sleep. You would have been sleeping. So it would cost you sleep to watch this lecture. You're doing the CA course. If not the CA course, you would have been doing something else. So do CA. Other than the financial cost that you have actually spent out of your pocket, it has cost you something else. Maybe you would be working somewhere as an accountant or something else, you would be doing some business, something or the other. That is your opportunity cost. So even in investments, you'll also have to see the opportunity cost. Like if I can get 9% buying it directly from equity market, I would rather go for mutual funds because mutual funds will give me somewhere around 12%. Correct? So I'm comparing. Why should I do all the homework, struggle, take decisions? I'll just go and put my funds in mutual funds. It gives a return of 12% on an average basis. So that is also important, our opportunity cost. Okay, it's the repetition over here. It is known as opportunity cost or cost of capital. This is what you have studied in your intermediate. Correct? Cost of capital. There was a separate chapter in financial management. Cost of raising funds. So if at all your returns are less than your cost of capital, that does not make sense. Because if you have to borrow at 10% and get a return of 8%, does that make sense? No. So my required rate of return should be more than cost of capital, or it can say it should be at least. So required rate of return is your cost of capital. So that's the first concept that we have, that is required rate of return. Okay, we'll move further. We'll move to the discount rate. I have spoken about discount rate in that concept that I did in the beginning of this subject. Correct? The very first video is on concept of present value. You need to go through that. I have explained about the discounting rate, why it is required and how it is done. Now, what is this discount rate? It is the rate at which we need to discount our future cash flows. The value of money keeps coming down. I told you, 100 rupees that I'm getting today, its purchasing power is not 100 after 1 year. It comes down. So we need to discount the future cash flows. It depends on risk-free rate and risk premium. What is this risk premium now? A minute. Okay. What is this risk premium? The return that you get for taking additional risk. Like I told you, FD is giving me 7%. But now I have decided to invest in equity shares. So I want some extra return. Otherwise, I'm not going to invest. So that is the risk premium that we are talking about. The return that you get for taking additional risk. Variations in discounting rate arise from factors such as expected inflation. That's why I said it's a very complex topic, because I may think inflation is 6%, another person may think inflation is 7%. My required rate of return might be 7%, another person required return is 15%. So expectations are different. So that is coming out of inflation. Maturity. If I'm investing for 1 year, it is a foreseeable future. I'm investing for 3 years also, I might be fine. But if you tell me I have to invest it for the next 30 years, then I'm taking more risk. We do not know what is going to happen in 30 years. So higher the maturity, more is the risk. Higher the inflation, more is the risk. Liquidity risk. What is this liquidity risk? If you are not able to redeem your investments or liquidify your investments as and when you want for the price that you want, then we say it is not very liquid. Real example is real estate. You have land, your property. You say, I have a lot of property. I have 10 crore worth of property. But do you have a ready buyer for 10 crore? So we have liquidity risk. FDs, I can just redeem it. Maybe some small penal charges, but it is liquid enough. Equity shares, which are traded daily in the market, the top companies, they are liquid enough. I can sell it quickly. So the risk is little less over there. Default risk. Now, what if they only do not pay you back? What if the company goes into liquidation? What if the debenture that invested, the company goes into liquidation? All these are possible. So many companies have gone bankrupt. So that risk is also there when you are investing. So your required rate of return and your discounting rate will depend on all of these things. So if at all your inflation is high, your discounting rate will be high. If your maturity period is high, discounting rate will be high. Liquidity, if it is not very liquid, your discounting rate will be high. And if the company has a history of defaulting, or you think the company is not doing very well, if you have default risk, then also you need to discount it at a higher rate. We'll move to the next part. Internal rate of return. Another concept, something which we have studied in intermediate. Correct? We have studied this in intermediate. We call it as IRR. Okay. If you can recall, what is IRR? It is that rate at which present value of cash inflow is equal to present value of cash outflow. We use this meaning for the purpose of calculating IRR for getting the answer. Maybe we did not go that much into detail. Now what exactly is IRR? See, I told you our discounting rate is cost of capital. Correct? The cost of raising additional funds. The borrowing rate. The rate at which we can get funds from investors. This is all cost of capital. Let's give a number to it. Let's say my cost of capital is 10%. Now I'm getting the funds at 10% on average basis. Now I need to generate return. Let's say I've invested 1 lakh rupees. Okay, I'm writing it down. I've invested 1 lakh rupees. After 1 year, if it becomes 1 lakh 10,000. Now what is the rate of return that you got? 10%. Correct? So is it enough? No, because I said your cost of capital is 10%. So you would want something more. And what we are doing in IRR is we are calculating what is the return that we are generating internally. That means the company is generating. So get the clear difference between these two. Discounting rate is the rate at which you get funds. IRR is the rate of return that you get by utilizing those funds. I'll repeat again. Cost of capital is that rate at which you get funds, and IRR is the rate of return that you get by utilizing those funds. So what we do is we find out that discounting rate such that present value of cash inflow is equal to present value of cash outflow. So basically here it is 10%. I said now let me change this to 20, 1 lakh 20, this becomes 20%. But this is possible only when you have 1 year ka cash flow. But when we have multiple year ka cash flows, we have first year, second year, third year, then we cannot calculate a simple average, right? Because the time value keeps changing. So what we do is it's an average annual return. I'm highlighting this. It is average annual rate of return. If it is 1 year, I told you directly we can calculate. It's simple thing. 10 to 1 lakh to 1 lakh 20 is 20%. But if I say I got 20,000 in the first year, 10,000 in the next year, it's not 20 plus 10 divided by 2. You cannot do it that directly because we know there is concept of compounding and all of that. So that's why we calculate IRR, which is average annual rate of return. Let's see how much of this we remember. We'll solve a question on IRR. Just a small recap of what we did in intermediate. Okay, we'll do this quickly. Question number 1, calculate IRR. So we have cash flow of 20,000, which is the cash outflow within brackets. Then we have first year ka cash flow, second year ka cash flow. What is IRR? It is that rate of return at which present value of cash inflow is equal to present value of cash outflow. So I'll write year column. Hope you have good memories of this IRR. Then we have cash flows. We have 20,000. It is outflow. We have 3,000. We have inflow, and we have 23,000, which that is inflow, right? Without a bracket. Okay. And we have 23,000 also, which is inflow. So remaining part I am writing in a different color. We'll go for red maybe. Okay. This is the question part. Now, how do I find out IRR? First, we will take a random rate. Correct, and we have to make the NPV equal to 0. I said present value of cash inflow is equal to present value of cash outflow. NPV by, now you already know we have solved enough questions from intermediate and also in the chapter that we have already finished, that is capital budgeting. So we will now take present value factor. I'll start from 10% because we are used to taking this, and by now you must be knowing it by heart. I definitely know it by heart. Okay, so for year 0, what is the factor? Year 0, I've kept repeating this so many times, it is equal to 1. Today's 1 rupee is today's 1 rupee. After 1 year, it becomes 0.909. What it means is receiving 0.909 today is same as receiving 1 rupee after 1 year. If I have to say the other way around, if I'm receiving 1 rupee after 1 year, I would rather receive 0.909 today because the values are same. Okay, where's this Siri come? Okay, it's gone off. Next, we'll take the second year ka factor 0.826. Then I'll multiply. Okay, present value of cash flow. This is at 10%. I'm sure there are many more columns that are required. We'll use calculator, but definitely not for the first one. This is negative 20,000. 0.909 into 3. 3,000, right? Yes, we get 2727. Okay, and we have 0.826 into 23,000. We get 18,998. We add 2,727 and reduce 20,000. We get, I think I missed something. 18,998 plus 2,727 minus 20,000. We get 1,725. Balance is still there. Correct. We need IRR to be equal. I want NPV to be equal to 0. What is NPV equal to 0? IRR rate, that discounting rate. So what I'll do is now I'll increase the discounting rate because I have a positive value. If I increase the discount, my value comes down. Correct. So you ask for more discount when you want to buy it for lesser. So we'll go for present value factor. Let's go for 13%. Okay, how did I take 13? It's a random value. First we definitely have 1 only. Okay, then how do I do 13% discounting rate? 1 divided by 1.13, I get 0.9, and we have just a minute. 1 divided by 1.13, so it's 0.89. 0.89. No, I need more decimals. No, 885. Okay, I have to just change the settings in the calculator. Then further we have 0.783. 0.783. So I've taken the 13% factors. I'm sure you know how to do this. 1 divided by 1.13, then you press equal to twice. Okay, then we have present value of cash flow at 13% for n number of years. This is negative 20,000. Then we have 3,000 multiplied with 0.885. We have 2655, and we have 23,000 into 0.783. We have 18,009. Still it's a lot, is it? Okay, my 13 is not enough. Plus 2655, and I still have a balance of 665. 664, it is 664. Still have this balance. It's still a positive value. So what I need to do is I need to go further. Let's say maybe 16% should get there, I guess. Okay, present value factor 16% for n number of years. Definitely the first factor is 1. 1 divided by 1.16, I get 0.862, and I have 0.743. Now when I multiply present value of cash flow 16% for n number of years, negative 20,000, 0.862 into 3,000, 2586. Discounting is required more from the second day because it's a huge cash flow. 23,000 into 0.743, 17,089 plus 2586 minus 20,000, and now we have negative 325. Okay, negative 325. So now we have one above, one below. We can continue. I'll go to a different color now. Let's go for green. Okay, so how do we calculate IRR? IRR is equal to, not giving you formula as such. Okay, if you can recall from what we did in intermediate, we'll continue that way only. Okay, so now what we have is IRR equal to how much more is required to be discounted. At 13% we got 664. So 664 more was required, divided by how much did we discount? 664 plus 325. This one, 664 plus 325. Why plus? Because minus of minus becomes plus. Basically it is from year to year, this value, what is the total difference that we have. Now that difference we got out of 3%, so into 3. So let's see what we get. 664 plus 325, 989. Oh, I missed the lower percentage, right? Okay. Small correction in the IRR calculation. Write the lower percentage. IRR is equal to lowest is 13, 13 plus. So we have 13 plus 2.01, which is around 15.01 percentage. 15.01 percentage. Make sure you write this 13 plus, because the lower percentage is 13. After 13 we wanted to discount so much, 664 more was required to be discounted, and this is what we actually discounted. Let me repeat that again. 13, from where did I get this 13? 13 came from here. Okay, we'll change the color. Probably go for all the colors I've used. Is blue will go for. Okay, this 13 is coming from here, because at that particular percentage we got this 664. That was the above one. Then we have 664 more, that is coming from here. 664 divided by the difference, 664 and this one. Now where is this 3 coming from? This 3 is coming from 16% minus 13%. 16 percentage is here, 13 percentage also I have highlighted. So from there we are getting this, the difference between the two, and we got the IRR to be 15.01 percentage. Why do we need this? Now this IRR is compared with required rate of return or the discounting rate. Now if at all I am discounting at 12 percentage, my NPV will be positive. Or I can also compare it this way. 12 percentage is what I want, 15 percentage is what I'm getting, then definitely that asset should be bought. So it is underpriced. So all these outcomes we get only after calculating IRR. So that was the concept of IRR. I'm going to clear this. Okay. So we have finished 3 concepts over here. We started with required rate of return, the return that we want from our investments. Discounting rate, we use that rate only for the purpose of discounting future cash flows. And internal rate of return is what we get out of the funds that we have utilized, what the company generates. We'll go to the next part. Equity risk premium and required return on equity. Now we are coming to equity shares in particular. Okay, only equity shares. Equity risk premium. I already told you what risk premium is. What is risk premium? The return that you get for taking extra risk. There's always something which is riskless, something which is backed by governments, the funds from the government, sovereign guarantee that we say. Correct? Let's say government bonds give you 6%. That's considered risk free. But if you invest in FD, small risk is there. That is a risk premium for taking that small risk. But if you buy equity shares, there is bigger risk. So when you take bigger risk, you get bigger return and you get this risk premium for equity shares. Required rate of return, because if you don't get that return, there is no point investing in that particular equity. Now how do we calculate this? So these formulae look very familiar because all this is coming, the base for this is coming from your intermediate. I hope you have studied really well, not just for the examination, because same concepts are repeated again and again over here, using it for complex problems. Equity risk premium is the excess return earned from equity investments over the risk-free rate. Government bonds is the example for risk-free rate. So we are taking extra return for that. Okay. It compensates investors for higher risk involved in investing in equity shares. I've already covered that. It is based on the risk-reward trade-off. What is this risk-reward trade-off? It's a common saying, right? When you take higher risk, you should get higher return. Otherwise, it does not make sense for you to invest in that. If I tell you, if you buy equity shares, you'll get 3% return per year, you will not be convinced. You'll be like, why? I can take less risk. No, I can take FDs I'll get 6%, 7%. Why should I invest? Why should I take that risk and get this return? If I told you do CA course, you'll get 25,000 per month as salary. Would you take that risk? You've taken a big risk, correct? There is risk of not clearing. There is risk of your mental health being spoiled. There is risk of not having social relations. There is risk of your friends just ghosting you. All this is possible. There is risk of not having a life partner. I mean, at least the partner right now, not the life partner that you'll get later. So there are so many risks that are there in this course. But why did you take it up? Because you felt the returns coming from this particular course is good. Maybe money for most of us, status, or maybe you want to prove somebody that okay, I can do this. But there are reasons. But you felt the returns are good enough for the risk that I'm taking. That is risk return trade-off principle. Investors expect equity returns to exceed risk-free return to justify investment in stocks. That's understandable. This is a formula that you had in cost of capital chapter in IPCC intermediate. We have RF, that is the risk-free rate of return. Then we have beta of the security over here. Now this will be covered separately. How to calculate this is separately covered in portfolio management chapter. Okay, how to calculate it, formula, everything is there over there. For now, what we'll know is it is a sensitivity factor. RM minus RF, this is the risk premium. Is it written here? RF minus RF separately, they are not written, no? Okay, risk premium. Market return. Now, if that all market is giving 12% return, risk free, let's say 6%, that means 6% extra you're getting for taking the risk. And then it depends on your stock, that is beta, how your stock acts, and that's why we have beta of X. I'm not getting into more details right now because I told you this is there again. The entire thing gets repeated. This entire formula gets repeated again in portfolio management. Okay, so that's how we calculate R of X, that is expected return from equity. We usually use this only for discounting equity shares. Fine, this is a small question over here. Feel like still you are in intermediate on this small question, something which you already had. Risk-free rate of return is 5%, beta is 1.5 times. Okay, it's written in times. Market risk premium is 4.5%. Okay, this is RM minus RF. Directly it is given. Market risk premium. Calculate return on equity. Required return on equity. Switch to blue. Okay. Fine. So we have required rate of return. We can call it as R of X. Okay, required rate of return, or we can also call it as KE, cost of equity, also equal to RF. RF is, let me write down the formula, otherwise RF plus RM minus RF multiplied with beta. Okay, RF is how much? 5% plus RM minus RF is given directly 4.5, beta is 1.5 times. We'll complete this equation. We'll multiply 4.5 into 1.5. 6.75 plus another 5%, we get 11.75%. Now this is the required rate of return from your particular stock. Next, we'll go to the next part, discount rate selection in relation to cash flows. Concept of nominal cash flow and real cash flow. What is this nominal and real? Let's understand this in detail. Okay, we have two parts over here, nominal cash flow and we have real cash flow. In simple words, nominal cash flow is the cash flows that we get over a period of time. First year you got 1 lakh, second year you get 1,50,000, third year you get 2 lakh. All these are nominal cash flows. No adjustments. What is coming in, what is going out, that cash flow is taken. Now what is this real cash flow? I've already told you, money loses its value. We call it as time value of money. Different reasons, not getting into that. But our purchasing power comes down. So even if you get 1,10,000 in the second year, we don't feel like it is 1,10,000. It is little less than that. We adjust that cash flow. The nominal cash flow that I already told, the real cash flow is the adjusted cash flow of nominal cash flow. Just for example, let's say nominal cash flow is 1,05,000. But you feel that 1,05,000 is not really 1,05,000 which I am getting after 1 year. It is equal to the real cash flow. Let's say it is equal to 1 lakh only. What I'm saying is it is like receiving 1 lakh right now. It is more like the discounted cash flow. Okay, that is real cash flow. Nominal cash flow refers to future revenues, expenditure without adjusting to inflation. That means whatever comes in goes out. That is taken. No other adjustments. It represents cash flows in actual monetary terms expected to be received or paid. Already covered this. Example is also given. Forecasting revenues and expenses such as wages, electricity, water, gas while investing in a utility plant. Everything, the real amount that you pay, what you receive. Cash flows is nominal. Okay. Real cash flows represents cash flows after adjusting to inflation. So that much will be deducted. It reflects the true purchasing power of money over time. Inflation reduces the value of money, which affects real cash flows. So if I tell you your salary is going to be 5 lakhs after 30 years, now I'm sure most of you will take it happily. 5 lakh per month, okay? So you'll be happy, 5 lakh per month. But if I say after 30 years, you'll get 5 lakh. You'll be like, what is 5 lakh? It may not be much. Correct. So we do not get the right picture, so we adjust it to inflation and we calculate real cash flows. Inflation reduces the value of money, which affects the real cash flows. In the short term or during low inflation, if inflation is hardly anything like we have in some countries, nominal and real are almost the same. So what is important is inflation. Inflation will decide the difference between nominal cash flows and real cash flows. During high inflation, nominal cash flows are higher than real cash flows. But remember one thing, your real cash flows are always lower, considering we have little bit of inflation at least. Now we'll come to the selection of discounting rate in equity valuation. Now when we do valuations, we need cash flows. We need discounting rate. So which discounting rate should be taken? Which cash flow should be taken? I've told you we have two cash flows. We have real cash flows, nominal cash flows. So if you take real cash flows, you have to discount with real rate of discount. If you take nominal cash flows, we have to take nominal discounting rate. And all that we have been doing so far in intermediate was nominal cash flows. Real discounting rate we have not used in intermediate at all. Fine. So nominal cash flow should be discounted using nominal discounting rate. Real cash flow should be discounted using real discounting rate. It's a repetition of what I just said. In equity valuation, only nominal cash flows are used. So we are still continuing with this same thing. Okay. When cash flows are available to all capital providers, who are these capital providers? We have equity shareholders, we have preference shareholders, we have debenture holders, we have long-term loans. All this gives you rise to capital. And if you remember, we calculated weighted average cost of capital. Now this is the discounting rate after tax, definitely after tax, because if you remember, we had KD formula I1 minus T net of taxes. We had other formula also. All of them were net of taxes. So WACC, weighted average cost of capital, is calculated after taxes. So if at all we are doing equity valuations and we are considering cash flows to all the capital providers, then we are going for WACC as the discounting rate. Knowingly, unknowingly, we have always used this. Like in capital budgeting problems, the terms were used. The cost of capital for the company is so much, and we considered that only to be the discounting rate. So knowingly or unknowingly, we have already used it and will continue to do the same. Valuation of equity shares. Now we are coming to that part of the chapter where we are valuing equity shares. The chapter name is Security Valuation. So under that we are considering equity shares based on dividend. Okay. So have we done this as well? We have done it. We have done it in dividend decisions if you studied it in intermediate level. ICS syllabus kept changing. Dividend decisions was there in finals. When I was a student, then it went to intermediate. Then again it was removed for some time. Then they brought it back again at intermediate. And now I think as of now today it is there. Okay. And also it is there at final level. But whatever it is, I believe you have studied dividend decisions. So it's again repetition. Dividend is the reward to equity shareholders for providing equity capital. We know this. Equity shares can be valued based on dividend expected from them. See, what is dividend to investors? If I am the company, I am giving you dividend. For you, what is it? It is cash flow. So you'll get dividend from me, cash flow this year, cash flow next year, and the year to follow. You'll keep getting dividend. That is your cash flows. And how do we calculate present value of an asset? It is by discounting future cash flow. So basically in these models, dividend based models, we are discounting the future dividends. Okay, some assumptions are required. Always with the models comes assumptions, with the theories comes assumptions. Dividends are paid annually. First dividend is paid at the end of the first year, because when we discount the cash flows, we discount it from the end of the first year. Otherwise discounting gets little difficult, correct? Dividends are discounted at required rate of return, opportunity cost, or cost of equity. Your dividend is coming from equity shares, so we take cost of equity. Thus the value of equity share is the present value of the stream of expected dividend over the holding period. So the total cash flows that you're getting, we are discounting that and we are saying that is the value of that particular asset. All of this you have done. As I turn to the next slide, you know that you have done this. Valuation based on holding period for 1 year. That is, you're just holding it for 1 year. What would be your return? If an investor holds the share for 1 year, then the value of equity share is computed as. Then there is a formula given over here. Looks like a little complicated formula, right? Okay, so this is dividend. What I'm highlighting now? Dividend at the end of year 1. This is the discounting rate, 1 plus KE. Correct? Then we have P1, price that you are getting at the end of year 1. And that also your discount. So if you invest today, that is cash outflow for you. Dividend that you receive after first year, cash inflow. And also the price that you get at the end of the first year, because you're holding only for first year, that is your return. Correct? The formula looks a little complicated. Basically, remember this. You will have cash flows at the end of year 1. So it is cash flow end of year 1. Multiply that with present value factor of a percentage, let's say I percentage for n year. So we apply this, we get same answer. Correct? So let's see one question on this. You don't have to remember this formula. With the help of the problem, I will tell you how we can get it easily. The formula is just a copy paste of what is there in your institute material. We'll ignore this for the time being. Share of X Limited is expected to be sold at 36 with a dividend of 6 after 1 year. If the required rate of return is 20%, then what will be the share price? So they're expecting it to be sold at 36. Okay, so P1 is equal to 36. D1, dividend that you're getting is 6. So what is your cash flow? Cash flow of year 1 will be 36 plus 6, which will be equal to 42. So 42 rupees you're getting after 1 year. So price right now, P0 is equal to 42. Multiply that with present value factor. Present value factor at 20%. Okay, we'll write that separately. Here we'll directly write the values. Okay, present value factor at 20% for 1 year. What is the factor? 1 divided by 1.2, you get 0.833. So we get 0.833 equal to, we get 34.986. This is the price of that particular share. Now, if at all, how do we take a decision? It's all about valuation. So we have done the valuation, but how do we take a decision? If at all the current market price of this is below 34 point whatever 986, then we think, oh, it's available at less in the market. This is our valuation. But if at all the price is much more than this, then we think, oh, it's overpriced in the market, and we do not buy what is overpriced. So I've not used the formula that is there over here. Okay, I've directly used a present value concept. If I still have to do it using their method, I will switch to red color. Dividend 1, that is 6 rupees. No, I'll show it over here. 6 plus P1. P1 is how much? 36 divided by 1 plus 0.2 raised to the power 1. Raised to the power 1 is not even required actually. So we have 42 divided by 1.2, right? 1.2, I get 35 as the answer. 35 as the answer. Correct. Here also it's almost 35. We got a slightly different answer because of this factor 8.33. It won't make much difference. Anyways, 34.986 is 99. 34.99 is 35. So it also depends on the decimals over there. So I'll use any of the methods, you get same answer. Fine. So we'll move to the next part now. Valuation based on multi-holding period. 1 year it was fine. I just used 1 year ka factor. I got the answer. Now what if you're holding it for longer period? Then what happens? First we have a zero growth. In zero growth, we are not expecting our dividend to grow at all. So first year dividend is 10 rupees. Next year also it will be 10. Following year also it will be 10. The year to follow also it will be 10. Same forever. Then if you see, this looks familiar. Correct. This is our present value ka formula, R divided by I. Again coming from the concept of present value. So that's the importance of that particular concept. That's why you should get that concept thoroughly, in and out, not for just for the purpose of getting answers in the questions over here. So in no growth model, we are using the concept of annuity perpetuity, dividend that you are receiving forever, taken by the discounting rate. Let's see, we'll solve one question using this formula. A Limited has consistently given a dividend of 5 for the past 5 years and is expected to continue for near future. If the required rate of return is 12%, compute the value of the share. So price right now P naught is equal to, we have 5 rupees dividend, same dividend forever, and discounting rate is 12%. So 5 divided by 0.12 will give me 41.67 per share. Simple. 5 divided by 0.12. That is when we have zero growth. We are not having any growth at all. Every year dividend is same. When we have constant growth, first I'll come to the formula. When you have constant growth. Now this is the formula for present value of annuity perpetuity. That is same value you're getting forever when annuity is growing at a constant rate. We had this formula also, R divided by I minus G. So the formula was present value is equal to R divided by I minus G. Same formula again given in concept of present value. So what happens over here is, let's say my dividend starts with rupees 100. Okay. Next year also I get dividend, but my dividend is also growing. Let's say it is growing by another 10%. So 100 becomes 110. So year 1 100, year 2 110, year 3 110 ka additional 10%. How much is that? 121. Correct. And then it continues. So growing annuity. So when the growing annuity is there, we use this formula. Price right now should be dividend at the year 1 divided by KE minus G. Constant dividend assumption is quite an unrealistic assumption because you cannot keep giving same dividend. Investors will ask like for growth, where is the growth? Accordingly, one very common model used is based on common constant growth in dividend for infinitely long period. In such a situation, we use the formula. Now we'll use the formula in the given question. Question number 5. Compute the price of the share if the dividends of the company are growing at 5% per annum, assuming a required rate of return of 20%. Last paid dividend from the company is 6. So what is this 6? 6 is D naught. D naught is 6. So what is D1? D1 will be 6. We have to add 1 year ka growth. 1 plus 0.05. 6 into 1.05 will give me 6.3. So this is D1. I want KE. What is KE? Equal to 0.2. What is G? G is equal to 0.05. Using these values, I'll get P naught. P naught is equal to 6.3 divided by 0.2 minus 0.05. 6.3 divided by 0.15 will give me 42 rupees. Now this becomes my value of the share. This is nothing but annuity perpetuity. Okay, next, variable growth. So what did we assume in the previous one? Dividend is growing, but then it is growing at a constant rate forever. Now that also looks unrealistic. First we had dividend that is not growing. We said that is little unrealistic, so we'll take growth. Now we are saying that we cannot grow at the same rate forever. Business will saturate at some point. So we are taking variable growth, 2 stages. While simple 2-stage model assumes extraordinary growth, but it won't continue for forever. So it is only for finite number of years, and only after that normal growth will prevail. How to solve this? Directly I'll take a question, because ultimately we are using the concept of present value everywhere. A Limited has paid a dividend of ₹7. The company is expecting a growth of 3% for the next 5 years and 2% after that. Compute value of share. So what we'll have to do here is we'll have to write down the years and the cash flows, okay, or I'll call it as dividend. Fine. So right now company has paid, it is given. So year 1 I will not be receiving 7. It is 3% growth. So it is 7 into 1.03, whatever this value is. Year 2 it is 7 into 1.03 raised to the power 2 years. Correct? Or we can take the answer that we get 7 into 1.03. This answer is 7.210. Correct? For this I can do into 1.03. I get same answer. I get 7.426. Even if you do 7 into 1.03 raised to the power 2, you get same answer. Fine. How do you want me to write it? I will write it over here as this way only, because I need the number of years. No, it will be easier. Then I'll write 7 into 1.03 raised to the power 3. So into 1.03, if I multiply again, I get 7.649. Year 4, then I have 7 into 1.03 raised to the power 4. How much is it? 7.649 into 1.03. I get 7.878. Year 5 also it is growing, same rate. Raised to the power 5. I get 8.114. And from here it continues at 2%. Correct? So we have year 6 up till infinity. 6 up till infinity. First I have to multiply this with 8.114. This should be multiplied with 1.02. 2%, no? 1.02 divided by, we are growing at a particular rate. The discounting rate is not given over here. We'll assume a discounting rate. Okay, we'll take 10%. Okay, discounting rate or required rate, discounting rate is equal to 10%. So when you're growing forever, we have discounting rate 0.1, 10% minus growing forever at 2%. What is the answer that you get for this? Into 1.02 divided by 0.08. I get 103.45 when I simplify this particular equation. So these are the cash flows that I have now. Next I would write discounting factor, present value factor, 10% for n number of years. Okay, year 1 we have 0.909, 0.826, 0.751, 0.683, 0.621, and now we have 6 to infinity. Now again we have to borrow concepts that we studied in the concept of present value. When I have 1 to infinity, value comes down to year 0. 6 to infinity also I have done over there. 6 to infinity, it comes down to year 5. So we have to use the factor of year 5, 0.621. This is nothing but the terminal value. 1.3.45 is the terminal value. Now we'll multiply 7.21 into 0.909, 6.554, 7.426 into 0.826, 6.134. We'll put that in memory. 7.649 into 0.751, 5.744 memory plus 0.683 into 1 point 0.683 into 7.878, we get 5.381. We'll put that in memory. 0.621 into 8.114, we get 5.039. We'll put that in memory. And last we have 103.45 into 0.621, 64.242. We'll put that in memory, and the final memory recall is 93.09. So this becomes the value of your share. Present value of future cash inflows. I'm just confirming by adding the value 6.55, 6.13, 5.744, 5.381, 5.03 plus 64. You get almost 93. 93 is the value of your share. So this is how you do it when we are 2 stages. That is, up till 1 stage, certain cash flows will grow at, the cash flows, the dividends will grow at a certain rate, and after that the rate comes down, the super growth rate comes down, and we grow at a constant rate forever. Now what if you have 3 stages? 3-stage dividend. So first we went with the concept that is saying we have no growth at all, same dividend every year. Then we said growth is there, but same growth every year. Next we said growth is there, but then first it will be a particular rate and then the growth changes. Now we are coming to a stage where the growth changes twice. In the initial phase, the firm grows at an extraordinary rate. After that, the advantage gets depleted due to competition, lending, leading to a gradual decline in its growth rate. This phase is the transition phase, which is followed by the phase of stable growth. Here also we have a question. I think even here discounting rate is not given. I'll write discounting rate equal to 10%. Fine. Company has paid dividend of 8 rupees. The company is expecting growth of 5% for the next 5 years, 3% for the following 3 years, and 1% after that forever. Okay. So in that case, we have year column, we have dividend column. We have year 1, we have 8 into 1.05. This time the growth is 5% raised to the power 1. Second one, you have 8 into 1.05 raised to the power 2. Year 3 we have 8 into 1.05 raised to the power 3. Year 4 we have 8 into 1.05 raised to the power 4, and year 5 we have 8 into 1.05 raised to the power 5. Compound interest formula. After that we'll see what to write. We'll get these values first. Okay. We have 8 into 1.05, 8.4 into 1.05, 8.82 into 1.05, 9.261 into 1.05, 9.724 into 1.05, we get 10.210. So these are your cash flows for the first 5 years. Then we are growing at 3% for the next 3 years. So we have 6, 7 and 8. So we have 10.210 into 1.03. Then we have 10.210, 1.03 square, and we have 10.210, 1.03 raised to the power 3. Next 3 years का dividend has to be found out. Okay, so we start with 10.21 into 1.03, 10.516 into 1.03, 10.831 into 1.03, we have 11.156. So we are done up till 8 years. Now we need 9 and forever, 9 to infinity. Next year के लिए we have 11.156. 1% is the growth because we need to get 9, and after that 1.01, 1% growth divided by discounting rate minus the growth rate. How much is this? 11.156 into 1.01, you get 11.268 divided by 0.09, you get 125.2. Now we have to apply the discounting rates. Fine. So for that we have present value factor 0.909, 0.826, 0.751, 0.683, 0.621. After that I need to check 0.565, 0.514, 0.467. Now we have 9 to infinity. So when we discount this cash flow 9 to infinity, we get at the beginning of year 9, which is end of year 8. Then we have present value of cash flows. Cash flows is nothing but dividends for us. Okay. So we'll do 8.4 into 0.909. 7.636, 8.82 into 0.826, 9.261 into 0.751. See, if you see, the dividends are increasing, correct, but our present values are still coming down. 9.724 into 0.683, 6.641, 10.21 into 0.621, 6.34, 10.516 into 0.565, 5.942, we have 10.831 into 0.514, we have 5.567, 11.156 into 0.467, 5.21, and we have 125 into 125 into 1 into 0.467, 58.468. Plus the grand total, I should get 110 rupees. I use the grand total function in the calculator. Just confirm. Let me take one decimal. 7.6 plus 7.3 plus 6.3 Yes, it comes to 110 rupees. So this is what you do. It's basically the same thing that we're doing. We're discounting the future cash flows till it goes to perpetuity. We will have to split the cash flows. We'll have to write down the cash flows and do it, because that's fine. We are doing it for a certain period of time. After that, we are taking stable growth. So this is the different ways in which we can find the value of the share just by using dividend. Let me just run through it. First, we have zero growth. So we have dividend divided by KE. Then we have growing dividend, but at a constant rate. Then we have growing dividend, first at a particular rate, then at a constant rate. Then we have three stages where we are growing at a very good rate, then at a medium rate, and then it stabilizes at a constant rate. All this while, we have been calculating the value of the share only on the base of dividend. But then sometimes investors do not want dividend. They will be like, we have given you money so that you can use it in the business. But now periodically you're giving us money back. And it is also affecting us because we'll have to pay taxes on it. You would rather keep that money for expansion, long-term growth, and give us money later. Correct. That's the reason I have invested. So even if you see the companies which give dividend, they are the companies we do not know what more to be done in that particular industry. Like the FMCG companies, IT companies, cash-rich companies. They may not want money for expansion. But if you look at the companies which are growing fast, they do not give dividend. They will use that money. How do they do that? They retain that. Correct? That's called retained earnings. So if you run through this, see investors willing to forgo current cash dividend. They expect higher earnings through retained profits. Okay. Retained earnings can lead to higher future growth. Such investors focus on long-term value creation rather than immediate income. So they're saying now don't give us in future. So if the company delays dividend, if I go by dividend models, then my value of the company comes down a lot. So we will have to use models based on earnings. Few formula are there over here. We have Gordon's model, Walter's model. Gordon's model is nothing but dividend growth model. Correct? Dividend discounting model. Okay. Here we have Walter's model, which is based on earnings. Same formula were there in your intermediate. Okay. This is D1, cash flow expected at the end, dividend. Discounting rate is KE minus G is the growth rate. And we have Walter's model. We have capital R. What does this capital R stand for? This is your retained earnings. What does this small r stand for? Small r is your IRR. K definitely is cost of equity. Another way to get the value is we go for EPS multiply with the PE ratio, which you added in ratio analysis. All this is a repetition of what we had intermediate level before we go to the higher level. So we'll take up a question, okay, something which we have done, we'll do it again. Gordon's model and Walter's model will be covered over there. Question number 8. A company has a book value per share of 137.8. Its return on equity is 15%. And it follows a policy of retaining 60% of its earnings. If the opportunity cost of capital is 18%, compute the price of the share today using both dividend growth model, that is Gordon's, and Walter's model. We'll start from the first one, that is dividend discounting one. P naught is equal to, what is the formula? Formula says D1 divided by KE minus G. D1 divided by KE minus G. We'll have to substitute the values and get the answer. But before that, we will have to find out the values. What is a D1 equal to? For that, first we need EPS. What is EPS equal to? EPS is 137 is our book value. Correct? We are getting a return of 15%. The return on equity is calculated definitely on book value only. If you remember the formula for return on equity, that is return divided by book value of equity. So now cross multiplying, we get the answer 137.8 into 15%. If I do, I get 20.67. 20.67 is our EPS. Now we want D1. D1 is 20.67 into, we retain 60 percentage. That means we pay out how much? 40 percentage, correct? So this is our D1, 40 percentage into 0.4. I get 8.268. So D is 8.268. KE. KE is the discounting rate. How much is that? Discounting rate is given to be 18 percentage. So 0.18 minus growth rate is required. G. What is G equal to? Growth rate. We have B into R. This formula has been used before. Correct? B is the retention rate and R is IRR. So retention rate is 60%. So we get 0.6. Retention rate is 0.6, 60 percentage, and R, our return is 15 percentage. So growth rate is how much now? 0.6 of 15. We get 9 percentage. So 9 percentage growth, 0.09. Now we'll get the final answer 8.268 divided by the difference of 18 and 9 is 9. So divided by 0.09, we get 91.867 per share. This is as per dividend growth model. Dividend growth model. We got it. Now we'll go to Walters model. Walters model. What does Walter say? P naught. P naught is equal to D1 by K. We'll write down the formula. P naught is equal to D1 by K plus we have RR by K square. Whatever values we know, we'll substitute. Equal to D1 we already got, no? Same value, we cannot change it. 8.268. K we have 0.18 plus capital letter R, retention. See, dividend was 8.268 out of 20.67. EPS is 20.67. Out of that, I'll reduce 8.268. Alternatively, I could have done 20.67 directly into 60 percentage. 20.67 into 60 percentage will be 12.402. Either ways you can get, I repeat again, either you can do 20.67 into 60 percentage, or we are reducing what we had done earlier minus 40 percentage. So we have 12.402 into small r, I've already written enough number of times, 15 percentage, so 0.15 divided by, we have 0.18 whole square. Simplifying this further now. Okay, we have 8.268 divided by 0.18, 45.933. I'll just keep this in memory. Then we have 12.402 into 0.15 divided by 0.18 divided by 0.18. This also will be in the memory. Total memory recall when I do, I get 103.35. So this is the value. We have used two different models. See, when we use only dividend, we got 91. And when we now go for earnings, we get slightly more than that, which is 103.35. Next, we have free cash flows to firms, FCFF. When I say firm, we are talking about all the providers of capital. Who are these providers of capital? We have equity shares, we have preference shares, we have debentures, all sources of capital. So what is available to them? The profit that is available to them is EBIT, earnings before interest and tax. But tax is not for them. So tax has to be given to the government. So 1 minus tax. Next we have add depreciation. Why add depreciation? Because depreciation is non-cash item. Then we have minus capital expenditure. because the cash goes out over here. When we calculated EBIT, we took only revenue items. Capital items were not considered. So capex being cash outflow, it has to be reduced. Then we have changes in working capital. Goes without saying, if your assets increase, your cash comes down. Your current assets increasing, your cash comes down. So that gives us the formula for FCFF, free cash flows to firm. But why do we calculate this? We will have to calculate ultimately the value of the firm. Value is equal to FCFF 1 plus G, growing annuity perpetuity, KO minus G. Because we have taken all the capitals, we will take cost of capital minus G. This formula also we have done it before, correct? Growing annuity perpetuity. Normally we had this one, D1 divided by K minus G, same to same. D1 is nothing but D0 1 plus G, correct? Here instead of D1 we have FCFF 1, because right now what we get is FCFF when we use this formula. So to get for the next year we have to add the growth. So this is the formula. Now we'll go to the next one where we have in the column we have free cash flows to equity. So here we are considering only equity shares, what and all we are getting. When it is to the firm, first one we took EBIT, but to the equity shareholders it is only the net income. We are talking about EA to ESH. EA to ESH. Add back depreciation, same logic because it is non-cash. Capex, same logic because the cash goes out. Net working capital, same logic because the cash is going out. But there is one additional adjustment, net borrowing. What is this net borrowing? Now, if at all the company has raised some amount of loan, cash comes in. It is not considered so far because we have considered operations. Capex we have considered, cash going out. So cash coming in also should be considered. No? So net borrowings is added to get FCFE. So with this formula, okay, we have to calculate value. Value is given by very similar formula, FCFE 1 plus G divided by, instead of KE we have KG. Instead of KO we have KE. Correct, because cost of capital was there. Now we are only taking equity shareholders. So we will take cost of equity only. So with this formula we should be able to solve problem. But before that there is something else. We are just having the differences between DCM model and free cash flow model. Okay. Dividend discounting model, DDM model and free cash flow model. What is the main difference? In the dividend discounting model, valuation is based on streams of dividend. We consider only dividend, nothing else. So if the company pays less dividend, tries to keep more cash with them, then that valuation is not considered. Then we keep cash for expansion purpose, but then that is not considered. We see only dividend in DDM. DDM assumes a stable dividend payout ratio which may be lower than the actual cash available in the firm. It values the stock only on cash paid out as dividend to the shareholders. DDM may not reflect the true intrinsic value. See, a company may give very less dividend sometimes. They earn 100 rupees, only 2 rupees is given as dividend. If that is the case, if they are maintaining large cash balance, then dividends will not give the right value of the company, and because of which you may undervalue the stock. Now this limitation was covered by FCFE model. Valuation is based on cash available to equity shareholders after meeting capex and working capital needs. Everything is taken if you check the formula. FCFE considers reinvestment requirements also wherever like capital expenditure, that is also reduced. Net borrowings, that's added before valuing equity. Reinvestment, here we are considering capex, that is already added, already deducted. Therefore FCFE model gives more realistic, very important, more realistic and comprehensive valuation. So this is the method that we are actually using in practical world also. More of this method. Dividends are not really used because it doesn't make that much sense, because the companies do not actually pay so much dividend. but the valuation should be based on what the cash is coming to the business and going out of the business. Fine. We can solve one question. Question number 9. Calculate the value of the share. This is the requirement value of the share from the following information. Okay. Profit after tax of the company is 290 crores. Equity capital of the company is 1300 crores. Par value is 40. These two information we can calculate number of shares if required later on. Debt ratio is 27%. Long run growth rate G value is given. G is equal to 8%. Beta is 0.1. Risk free rate RF is equal to 8.7. RM market rate of return is 10.3. Capital expenditure is given per share. Depreciation is given per share, and working capital loss is given per share. If you see my formula, we had given, the formula said capital expend capex, depreciation, changes in working capital. Per share was missing. Correct. So in that FCFE formula, we are basically calculating the total value of equity shareholders. Now here they asked value of this share, just one share. So what we'll do is we'll change the formula in such a way that everything we write per share. Okay. So we write EPS. We'll start the left hand side also. We write FCFE is equal to EPS. Why EPS? Because normally we write EA to ESH, that is net profit, and net profit divided by number of shares is EPS. Then we have depreciation. Depreciation is per share, but I'm not writing that. Minus capex, minus changes in working capital, plus net borrowings per share. Per share. I'm not writing every time. Only for EPS I'm writing because that is the normal way of writing it. No, earnings per share EPS. We'll leave one line to substitute the values and get the answer. Why are we doing this? To calculate value of the share. And how do we calculate value of the share? That is FCFE 1 plus G. I've written that, no? 1 plus G. I missed to write that time. No, I've written 1 plus G. KE minus G divided by KE minus G. Okay. Formula is there. Now next line we'll write the values and then we'll write the final answer over here. So here we'll complete the solution. So this will be the ultimate solution. We will support it with working notes. Whatever values we know we'll write first. G I remember reading 0.08. So we have 1 plus 0.08. Nowhere else, no? G is there, okay. FCFE we have to calculate. Depreciation we'll check. Depreciation is 39, capex is 47. Changes in working capital we'll see. 3.45. EPS we do not know as of now. Net borrowings also we do not know. So we'll prepare necessary working notes. We'll prepare the first working note 1, EPS. How do we calculate EPS? EPS is equal to EA to ESH divided by number of shares. EA to ESH is the first line of this question, 290 or 2900, I guess, not 290. I think it's 290, no? Let me just confirm. 290 crores. Then we have, when I came back over here, we have equity share of the equity capital of the company 1300, par value is 40. So these values will take divided by 40. This is crores, okay? Crores, and this is also in crores. So this will give me EPS 1300. I'll do the denominator first, divided by 40 will give me 32.5 crores. Denominator we have 32.5. So 290 divided by 32.5, crores and crores cancels. 290 divided by 32.5. 8.92. 8.92 is EPS. Put the value 8.92. Next we need net borrowings.
Okay, net borrowings. In this question, they said that net borrowings are debt to equity ratio. I'll come to that. I'll highlight that now. Debt to equity ratio. In fact, debt to value is given, debt plus equity. Debt to value ratio is 27%. What they're saying over here is, of my total assets, I have to keep 27% in debt, because debt plus equity is nothing but value. Value is nothing but the total of my equity and liabilities. Everything considered, debt, equity, long term, everything is considered. We get 27% for debt. So I can say of my total assets, 27% should be debt. Now what increases or decreases my asset? If there is capital expenditure, it will increase my assets. Correct. So that we have 47. Depreciation will decrease my net assets, because depreciation is reduced from the value of fixed assets. So 39 goes off. Changes in working capital. If my current assets increases, cash goes out. Correct. Because of which my assets increase. So that also should be considered. So we have 47, 39 and 3.45. We have 47 minus 39 plus 3.45. This much we have considered. On this, 27% should come from debt. 47 minus 39 plus 3.45 into 0.27. 3.0915. This much should come from debt. Correct. So this is my total increase in the assets into 27% is 3.0915. 3.0915. Coming very close to the answer. We'll add minus 3.45 minus 47 plus 39 plus 8.92. Very small value, we get 5615. That's okay if it is a small value, because it is per share. Ultimately, when we discount it, it may go to a bigger value, 0.5615. I will put that value over here. Now only one value is remaining, that is KE. Another working note for this. Working note 3. Cost of equity. Now this we are learning from intermediate. Cost of equity. Which formula we'll use? We'll use RF plus RM minus RF multiplied with beta, given the information that we know. Beta I remember reading 0.1. RM and RF will search. RM is 10.3 and 8.7. 10.3 and 8.7. Using calculator now. 8.86%. This is my discounting rate. 8.86 was what I got. Now we'll go back. Okay, we get 0.0886. Now we are almost there, ready for the answer. 0.5615 into into 1 point. We do that again. 0.5615 into 1.08. Okay, divided by 0.0086. Right, we get 70.5 as the final answer. This is the value per share. Fine. So even if you have to find the total value, all the values we will have to multiply with the number of shares. When we multiply the number of shares, we'll get the total value. That could have been also done. It's a very basic question. Okay. Later on, we'll see if we have more questions. We'll solve that as well. In fact, the concept itself is simple. Basically, you have to calculate the cash flow. Now, in this problem, it was value of the share. So we took FCFE. But if it was for the firm, that also was not a very difficult task. Okay, straightforward information is there. The only part which required explanation was this part, 27% of debt. Net assets 27% will be debt. Fine, so we got the answer 70.5. Enterprise value. Now, what is enterprise value? What we have done so far is value of equity shares. Now, what if you have to buy a particular company? Are you buying only the shares of that company? Along with shares, we also get its assets and liabilities. We get the entire company. Now that is enterprise value. So enterprise value is a much broader concept than just the value of equity shares, or what we call as market capitalization. I repeat, for equity shares total value, we call it as market capitalization. Now this is much broader than that. So let's see what exactly it is. Enterprise value is the true economic value of the company. That is, let's say you're planning to buy the company. Let's call it as takeover. If you're planning to take over the company, then what is its value? Let's say if you want to take over. Fine. It is calculated by adding market capitalization. What is market capitalization? I already told you, this is the value of equity. Different ways are there to value that, or if it is listed, you will also get the value in the market. Okay. Then we have net debt. Net debt, that is what you are supposed to pay and what you have already given to outsiders. If at all you have lent loan and all of that, that's why we see the net debt. So when you buy the company, the bank is not going to say this loan was not taken by you, so you don't have to pay. So you're taking over everything of the company, so net debt has to be considered. Minority interest. This is also to be considered. Now, what is minority interest? You must have studied this somewhere. Maybe in FR, when we consolidate statements, we also have to provide provisions for minority interest. Now, let's say we have 90% of the stake in the company. We have the parent company and we have another company, subsidiary company having 90% stake. So, what do? The 10% we give the credit, right? Minority interest. Now that also should be considered, because when you are buying the company, your company is as a whole, not just for this particular company or just for the 90%. Because ultimately when we compare with the different ratios, whether you're comparing with EBITDA and all of that, we will have to consider that. I'll come to this part of the explanation once again later on also, why minority interest is to be considered. Then we consider debt deemed provisions. If you have made extra provisions for the debts which you may have to pay in future, that also the contracts of the existing company also become your contracts on the event of takeover. Any other claims, maybe we will also consider the contingent one. Whatever claims are there, we consider all of that. Now, sum of all this, sum of the values of claims on enterprise profit or cash flow, everything together, we get enterprise value. So this enterprise value can be divided as core enterprise and non-core enterprise. Now, if I tell in simple words, core enterprise is your core business. Like a company can have multiple businesses, but one business will be their main business. Correct? If I talk about ITC, its core business is cigarettes, but then it has other different streams also. So you'll have to see the core enterprise value and non-core assets. Out of the total value, what is the core and what is non-core? Okay, so we'll see this now. Total enterprise value represents the value of all business activities, core, non-core, everything. Market capitalization, this is repeated, plus interest bearing debt, plus minority interest, minus cash. Minus cash. Cash should be reduced. Now, why cash should be reduced? Now, let's say you're buying a house. Okay, you paid the buyer only 30 lakhs. And he's telling you another 70 lakhs you have to pay to the bank, which he has taken as loan. So total how much you have paid indirectly? 30 to the seller, 70 lakhs to the bank, which you have to pay in future. But what you realize is, after you buy the house, there's 10 lakh cash inside the house. Correct? So that will be your net cost now. You paid 30, 70 to pay to the bank. Along with the house, you got 10 lakh worth of cash. So that will be reduced. Same thing with the companies. When you buy the company, you get assets, you get liabilities, you get cash, which is part of the assets, so that should be reduced. So everything is considered in total EV. Remember, total market capitalization, interest bearing debt, minority interest minus the cash. Next we come to operating enterprise value. Now what do we consider in this? Represents the value of operating activities of the firm. So here we considered all business activities. They may have investments in other companies, that is also considered. Here no financing activities, no investing activities. Here we take only operating activities of the firm obtained by deducting total value of non-operating assets. These we reduce. Investments, shares in associate. We want to see only for this particular unit what is its value. The core enterprise value represents the value of core business activities only. So here what happened? Operating enterprise value. Here what you did? Only the operating activities. Here we are seeing the value of the core business activity, calculating by deducting non-core assets from operating EV. So from this value that we have calculated, we further reduce which one? Non-core assets, which are not main requirement for our core business. Now what is the importance of this? Importance of enterprise value. Enterprise value, EV means enterprise value, measures the business as a whole and reflects its true economic value. Again, repetition of what is there earlier. Why economic value is important? Because when you buy a business, when you take over a business, you are seeing the business as a whole. You are not just buying shares of the company. It is more comprehensive than equity valuation methods. In equity valuation, we value only equity shares. We have learned some of the methods. And here we consider everything. EV considers both equity and debt, making it less affected by capital structure. So if there is one company, 90 debt, 10 share capital. Another company, 50 debt, 50 share capital. Both the companies will have same economic value. So for the purpose of comparison also it becomes easier. So your capital structure becomes not so important. Your ultimate value remains same. Enterprise multiples are more reliable than equity multiples, as equity multiples considered only for equity claims. So we have some ratios that we calculate using EVs, that is enterprise value. Now when you calculate this, if your capital structure is not the same in two different companies, then your ratios will get fluctuated, it will be impacted. So because of this enterprise value will not change based on your capital structure. So you will still get same ratios and easy for comparison. Now what are these ratios that I am talking about? See, enterprise value is used as a numerator. The denominator must represent cash flows available to all capital providers. First we will see EV to sales. Enterprise value to sales. We compare the value with respect to sales. So what do we have here? Numerator we put EV, enterprise value calculated in different ways, divided by sales value. Now again I told you earlier when I was explaining minority interest, why we need to add. See now when we take sales, when we do the consolidation, when you do consolidation of your parent company books with its subsidiary, let's say we own 90% of the stake. What do we do when we consolidate? We consolidate everything, full 100%. Later we give that 10% ka adjustment and all of that. Correct? But now EV if I don't do, there is no matching concept. So we will have to take minority interest in EV. In sales anyways we are considering. So this is one of the ratios. Why is it suitable? Suitable for companies with negative cash flows or earnings. See, the valuations usually work with EPS. Correct? So usually when earnings are there, we write EPS into PE will be your MPS. This is what we normally do. But let's say a company is having losses. If a company is having net loss, EA to ESH, earnings available to equity shareholders, will be negative. So does that mean the company's value is negative? No, right? We have so many loss-making companies which are listed and have a positive value. So that's because of enterprise value. So we cannot value the sales with respect to sometimes profit and market capitalization, because our enterprise value is more relevant when a company is loss making. Commonly used for cyclical and technology firms. Now, what happens usually with these cyclical companies is sometimes they have huge profits, sometimes they have huge losses. This pattern will not be the same. The ratio of debt, ratio of equity will also keep changing. So comparison becomes difficult. So these type of companies use EV. Also in the listed company space, if you actually see the loss-making companies, the new IPOs, or we call them as new age IPOs, when they are listed, they give the valuation based on EV because they have no profits to show. Correct. Now, one of the methods that we have for valuation is discounted future cash flow. What do we do in this? We have cash flows coming in years, we discount them. Now, if I tell you my cash flow is negative, how will you get its present value? So that method also goes off. So all these methods become not so useful. That's why we have the concept of EV. Okay, sales are the least manipulated and least affected by accounting policies. Now the accounting policies will be different in different places, but sales, the way of recording will still remain same. Everywhere sales is recorded this same way. Correct. The moment you make sales, we pass the entry. So sales is accounted in a particular way, EV is accounted in a particular way. It is not affected by the accounting policies. So that it becomes very helpful in the times of IPOs, valuation, takeovers, and so on. Then we also compare EV to EBITDA, earnings before interest, taxes, depreciation, and amortization. Okay, so we consider only the cash operating profit. EBIT is cash operating profit, but I'm taking non-cash items also out, depreciation and amortization. So EBITDA is a proxy for operating cash flow available to debt and equity holders, the cash that is available to the long-term capital fund providers, used for capital intensive companies with high depreciation. Like some companies make losses only because of this depreciation, because the capital that is invested in the assets, heavy machineries, it's huge. So the depreciation in the first few years is also a lot. Correct? We have seen that in income tax, the rates are high, and then there is WDV method. So because of all these reasons, depreciation in the first year will be very high, and because of high depreciation, the losses are also high. So we remove depreciation amortization. Widely used in mergers and acquisition, and is considers both debt and equity. I've already told you we use EV in the terms of takeover, listings, valuation for different funding, and so on. Correct. So mergers and acquisitions also, and two companies are coming together to merge. So we find the value at EV level, not usually at market capitalization. Then we are preferred by analysts since it is not affected by depreciation policies. It's a repetition. Okay. The inverse of EV to EBITDA indicates cash return on total investment. Now EV divided by EBITDA. If I do EV divided by EBITDA, what do I get? I get number of times. The number of times my value of the company with respect to EBITDA. Correct? For example, if I have to give, let's say my enterprise value EV is equal to 100 and my EBITDA is equal to 20. So what is my answer? 100 divided by 25 times. I am saying the value of my company, the enterprise value is equal to 5 times. 5 times of EBITDA. But if I do the inverse of this, I get 20 divided by 100. What is 20? 20 is the return that I'm getting for investment of totally 100, which is 20%. That's all that is said over here. Fine. Okay, that's all that is there in enterprise value. Let me just run through from the beginning of what is the main part of this particular topic. First, it is required to see the business as a whole. You're not just seeing one particular capital. You're seeing all the capital structures. You're seeing debt, you're seeing equity, you're seeing preference shares, everything. In addition to this, you're seeing also minority interest. But if cash is there, we'll reduce that part from the total value. In the second page, we came to why it is so important. I told you why it is important. Who considers it also, I told you. Especially if you have negative cash inflows, then cyclical companies and so on. Okay. Then the ratios that we calculate, EV to sales, and also we have EV to EBITDA. Fine. So very interesting concept. Need to know this from examination point of view. We'll now move to the next part. We have valuation of shares. Sorry, valuation of rights. Valuation of rights. Okay. When company needs additional funds, it's an existing company which needs additional funds. One of the easiest way to raise money is by issuing right shares. What is right share? You go and tell the existing shareholder, you are being there with this company for very long and now I need money. Can you please give me money? First right we are giving to the existing shareholders. Let's say market price of the company share is at 50 rupees. So you tell the existing shareholder, I will give it to you at 30 rupees. Don't have to pay 50 rupees for one share. At 30 rupees, I will give you right to buy. So if he buys at 30 rupees, that 30 rupees comes to the business. And that 30 rupees you can use it for the reason that you actually wanted. This is in simple terms, right issue. Now if the existing price is 50 rupees, I will say existing price 50, okay. Existing we have 50 and then we are subscribing at 30. Existing at 50, subscribing at 30, will the price post subscription remain same? Now let's assume it remains same. What can I do? I have 50 rupees, subscription 30. So I'll subscribe at 30 rupees and then sell it in the market at 50 on the same day or as soon as it is allotted. So this is like free money, right? Arbitrage, which is never possible in the market. Because I have told this many times, there is no free lunch. We think that we can do this and make money easily in the market. No, market will not allow. Market knows everything. So market says your price cannot remain 50. It was 50 before right issue, but after right issue, it cannot be 50. Can it be below 30? If it is below 30, then why would I go for the right issue? I can buy it from the market. So it has to be between 50 to 30. Correct. Now let's see how we can calculate this. It is called what? X right price. That is after the right, what is the price of the share? We have NP0 plus S. What is all this? N and N1. Two are there, N and N1. N is number of existing equity shares. What is N1? Number of new shares offered. Now what I'll do is, in my example, I'll take 1:1. That is, for every one share, investor gets right to buy one share. Correct. So we have N1 as 1 in my example, N1 also as 1 and N1 also as 1, 1 plus 1. After the right issue, he has 2 shares. Okay. P0 is the price pre-right issue. How much in my example? 50. S is the subscription amount. In my example, it is 30. Now if I solve this, what happens? We have N1. Oh, N is 1, not N1 is 1. N is 1. P0 is 15. Plus 30 divided by we had 1, we have another one. Now 50 plus 30 is 80, 80 divided by 2 is 40. Does it make sense? Because we had shares worth rupees 50, we paid another 30 rupees, totally we had 80 rupees investment. And what is the value now? We have 40 rupees ka shares and we have 2 shares, 40 into 2 is 8. Your value does not change. What your value was before plus additional amount that you have put exactly will be the value that you have at the end of the right issue. Further, we have theoretical value of the right. Theoretical value of the right. I'm not saying theoretical value of the right share. Now this is theoretical value of the right. How do we do this? First we need X right price. X right price is what we calculated. In my example it is 40 rupees minus subscription price. So we have 40 rupees over here minus subscription price. We only paid 30 now. So the value of the right is 10 rupees. Now if it is a listed company, you can trade this right, and the rights will actually be trading somewhere around 10 rupees. If a company has issued right issues recently, just check if the market price is 200 and they're giving the right at somewhere, let's say 150, depending on the ratio and all of that, the right will be trading, use this formula, somewhere close to this. Then there will be other reasons why it is trading at higher value, lower value. We will not get into that detail. Further, value of per shareholding. Okay, so per share, what is the value can also be calculated. Now I'll not get into this formula right now. This one I've explained. This one I will explain with the help of the next question. So in solve a question, okay, that question will cover all that we have discussed over here about the right issue. So as I go to the question, what is right issue? Right issue is the right of the existing shareholder to buy additional shares. Definitely it will be at a value lower than its current market price. But does the value change? No, it does not change. So we'll go to question number 10. ABC Limited shares are currently selling at 13 per share. There are 10 lakh shares outstanding. The firm is planning to raise 20 lakhs to finance a new project. What are the X right price of shares and the value of the right? First one is X right price. What is X right price? Let's come back to the previous slide. X right price is given over here, N into P naught plus S, N1 plus N2. Okay, we'll apply that. And there are sub questions over here. If is there, okay, so we'll see this. If the firm offers one right share for every 2 shares held. So we'll solve the first part now. Okay, 1:2 ratio. What would happen? So for that, we'll write down the formula. What does the formula say? X right price of the share is equal to X right price is equal to, we have N into P naught plus S divided by N plus N1. I have just written down the formula. We will not substitute right now. What we need to know now is, what is the subscription price? In my example, it given subscription price directly. Here, subscription price is not given directly. They said we'll give 1 share for every 2 shares held. So, my existing number of shares is how much? I'll write over here. Use a different color. Existing number of shares is equal to how much? 10 lakhs, right? Okay. So we're getting 1 share for every 2 shares. So right shares are how much? For 2 we are getting 1. So into 1 by 2, which is equal to 5 lakhs. Okay. Now we'll substitute whatever we have so far. We have 10 lakh. P naught is 13, right? I remember reading 13 somewhere. Yes, 13 current market price plus subscription value. Subscription value we are yet to find out. We do not know as of now. We have 10 lakh plus 5 lakh. These are the values that we know so far. Subscription value is yet to be calculated. Let's calculate that now. Subscription value. Now, how to calculate this subscription value? How much do we need? We need 20 lakh. Capital required is 20 lakhs. And we can issue 5 lakh shares. right? Rupees 20 lakh divided by 5 lakh shares. So each share has to give how much? 20 divided by 5, 4 per share. 20 divided by 5 is 4 per share. So my subscription is 4 per share. 4 into how much? 5 lakh, right? We have 4 rupees per share. Okay, we'll put 5 lakh here. 5 lakh first, 5 lakh number of shares into 4. Now we'll have to simplify this. So 10 lakh into 13, we have 1 crore 30, right? 1 crore 30 and another 5 lakh into 4, we have 20 lakhs. So we have 1 crore 50. 1 crore 50 divided by 15 lakhs, we get answer as 10. Okay, so we got the X right price as equal to 10. Makes sense, it was at 13 rupees. We are giving subscription at 4 rupees. The middle value somewhere in the middle, it's because of the ratio, it is tilted towards the higher side. So it is now at 10 rupees. Fine, so we have done the working. First requirement is met, that is X right price of the share. Now the value of the right. Now coming back to the page where you had the formula, value of the right is X right price. Now what is the answer that we got? Value of the right is equal to X right price minus subscription price. X right price is 10 rupees. Subscription price is, how much was it? 4, no? 4 rupees. So we are getting 10 minus 4, which is equal to 6 rupees. This is the value of the right. Now the third part, though they have not asked, we will still calculate this value of per shareholding. Okay. So we got the value as 6 rupees, but per shareholding. So you have to hold 2 shares for this, right? Okay. So 6 rupees divided by 2. Value per shareholding. Value per shareholding is equal to 6 rupees. For holding 2 shares, you are getting 6. So per share, the value of the right is 3 rupees. Clear? So that answers all the requirements. We have answered X right price of the share and also the value of the right. Both requirements are met for the first one only. Now we'll go to the second one. The firm offers 1 right share for every 4 shares held. So where all my calculations are to be repeated. Correct? Okay. So the ratio is 1:4. Okay. This is the second part. Right ratio equal to 1:4. So first we'll see number of shares to be issued, or we'll write down the answer first. X right price is equal to existing shares. This we have done that time, 10 lakh into existing price. Formula I have not written, I am directly writing the answer. It was 13 plus how many more we have to issue, we have to see, and at what price also we are yet to see, divided by 10 lakhs plus we are yet to find out how many more shares to be issued. Going a little fast now, okay? Then we'll prepare this working note, same in red again. So first we'll see how many shares are to be issued, okay? Number of right shares to be issued. How many will that be? That will be 1:4. So we have 10 lakhs into 1/4 divided by 4. If you do, you get 2,50,000. Done it directly this time. Okay, so let's find the subscription price. Subscription price is equal to 20 lakhs. We still need 20 lakhs. How we are getting it? with now lesser number of shares divided by 2,50,000. How much is this now? 20 divided by 2,50,000 should be 8, no? Just confirming, it has to be 8, it is double basically. That time we issued 1 for 2, now we are issuing 1 for 4. So per share also it will be more. So we have 8 rupees per share. We have 8 over here. We have 2,50,000 over here. Basically, if I multiply 2,50,000 with 8, you again get back 20 lakh. So basically that extra 20 lakh. Again here also, even in the previous problem, if you see this 5 lakh into 4 is 20 lakh only. Okay, 8 and denominator I have 2,50,000. Okay, so we have 10 lakh into 13, 1.3 crore, 1.3 crore plus same numerator we have 2,50,000 plus 8 is 20 lakh, 1.5 crore. So we have 1.5 crore. 1.5 crore divided by 12,50,000. We get rupees 12. So small decrease because we are issuing less shares. Initially it was 13 rupees, now it has come down to 12 rupees. We can solve the next part. Next part is to calculate value of the right. Value of the right is equal to 12 minus, no, it was 12, yeah, correct. 12 minus subscription rate is 8, 12 minus 8 is 4 rupees. And we also want value per shareholding, right? Value per shareholding equal to 4 rupees you are getting for holding 4 shares, you get just rupee 1. If you see the first part and second part, it is almost the same with just different ratios. Different ratios changing the answer, but the method remains the same. We'll now go to the third part. Okay, third part. We'll read the third part first. This is done. First part is done. Second part is done. Okay. Third part. How does the shareholders' wealth holding 100 shares change from 1 to 2? How does a right issue increase shareholders' wealth? Let's see what will happen if he goes for part 1 or he goes for part 2. Correct. Value we'll have to see after right issue what will happen. Okay, I think the values are changing, so we'll do it separately only, you know. Okay, we'll do it this way. Part 3, value if right issue is 1:2. So number of shares post right issue. Post right issue. So he had how many? 100 shares, right? So 100 plus 1:2. So you got another 50 shares. So these are the shares that he has. Into what is the price of each share post right issue? It was 13 rupees. No, I think it was 10 rupees. 13 was there in the beginning. Post right issue it is 10 rupees. Let me just confirm. Yes, X right price is 10 rupees, that is there. So 10 rupees is taken. 150 into 10. 150 into 10. It is 1,500. This is the value post right issue. But he had to pay some amount, right? So less amount paid. How much did he pay? He paid for 50 shares into subscription price was 4 rupees. 4 into 50, which is 200, and net basis is 1,300. Correct. That's 200 rupees is he paid, so he got that extra. So 1,500 minus 1,200. Now what if he had gone for the second option? Value if right issue is 1 for every 4 shares held. Number of shares post right issue. Okay. So we had 100 shares plus he got 1:4. 1:4 of 100 is another 25 shares. 125 shares into what was the price? What is the price? 12 rupees. X right price is 12 rupees. So 12 into 125. This is also 1500. So how much did he pay? Let's see. Less amount paid. He has got how much? 25 shares. And each share he got 8 rupees. You have to pay 8 rupees. So the net answer is same to same. So this is what I told you when I was explaining right issue. You will not have free lunch. Your value still remains same. Your value first was 1300. You added another 200. That's why it became 1500. Or you see it this way. You had 200 rupees cash with you. Now instead of cash of 200 rupees, you have shares worth rupees 200. Your value does not change. Value of the shareholder doesn't change irrespective of the ratio of right shares. If the value is increasing, then all the companies would have simply given right shares. No, it doesn't work like that. Your value ultimately does not change. But then maybe if at all you don't subscribe to these right shares, like the company says you can buy 1 share for every 1 share that you hold, and you do nothing. You will be like, no, I'm not giving you more money. Then what happens? Then your value drops. So you'll do something with it. You can renounce your right. All these options are there. You can sell your right to another person, at least for some value. Otherwise, your wealth will come down. It will not go up. Fine, that's it. That's it from about right issues. We'll move on to the next topic. Valuation of preference shares. So we're done with equity shares. We also did the enterprise value. Then we did the right share. Now we'll come to preference shares. Now 2 types of valuation is there. One is for redeemable. One more is for irredeemable. If it is redeemable, we know the future cash flows. The future cash flows can be in the form of dividend that we are receiving and the redemption value. We know the value of the asset is present value of future cash flows. So I will take preference dividend and redemption value both. Next we have valuation of non-redeemable preferences. We have this formula. We have used this formula when we had cost of capital KD is equal to PD divided by P naught. Intermediate. We have used this formula. Cost of preferences KP. KP is equal to PD preference dividend divided by P naught. So the same formula cross multiplication. This will give us the valuation. Correct. Also, it is the annuity perpetuity, which is coming from concept that I did in the beginning. Concept of present value. PD is there, which is your dividend forever. It's irredeemable, right? So dividend forever divided by discounting rate. So present value is equal to R divided by I. This formula. So combination of these all the concepts gives you the value of preference shares which are non-redeemable. For redeemable, I told you it is present value of future cash flows, and there is a question on that, question number 11. The face value of preference shares is 10,000 and stated for a dividend of 10%. So preference dividend is equal to 10,000 into 10% is equal to 1,000. The shares are redeemable after 3-year period. Calculate the value of preference shares. So we have year 1, year 2, year 3. We have cash flow on level, right? Okay, these are preference dividends. We have 1,000. We have 1,000 here. We have 1,000 plus 10,000, which is 11,000. Then it became 1 lakh, no? 11,000. Yes, because we are also redeeming in the 3rd year. Present value factor. At what percentage required rate of return? They said is 12% for n number of years. I will do 1 divided by 1.12. I get 0.893. Press equal to again. I get 0.797. And next, when that is equal to, I get 0.712. Now when I do present value of cash flows, need to multiply this. Okay, so we have 893 into 1000. Definitely just one zero to be added over there. So I get 8930, 1000 again 7970, and we have 11,000 into 0.712. You get 7832. Oh wait, I think I added one extra zero over here. We'll reduce that. Okay, into 1000, right? Okay. Fine. So now if you add this plus 893 plus 797, we get 9522. So this is the present value of the preference share. Now if you see, the current value is 1 lakh, or the face value is, in fact 10,000. Face value is 10,000, but the value that I'm getting, present value I'm getting, is 9,522. Why do you think the value is less? I know they have not asked, but let's try to understand why the value is less than the face value of 10,000. Because you need 12% here. What am I highlighting? You need 12% return. Your required return is 12%, and that is giving you only 10%. Your required return is more than the return that the preference share is giving, and that's why it is at a discount. It is less than 10,000. Fine. So same thing happens even with bonds. Like if your required rate of return is more, you want more, but the bond is giving less. Here also you want more, but the preference share is giving less. Fine. So that's the answer, 9522. It's nothing but the present value of future cash flows.